Okay, guys, welcome everybody. We're just going to give a couple of minutes just to see that we're going live. I think we are. Yep, we're looking good. So, Pat,
Yes.
obviously there's been some big moves going on in the market, and I'm sure everybody is shitting their pants. So, I think what we should do is really give them an update as to the situation. We haven't seen moves like this in years. So, can you tell us what the hell is going on?
Listen, Danny, uh, I was enjoying my weekend trip here to Mallorca. I'm supposed to be already in the on the beach drinking beers, and you're like, "We need to do a live stream," and I'm like, "You're right. You're right. We need to do one. This
We
is
do.
uh, this is a lot going on in the markets, and we have to discuss it. And so let's not waste any time
Yeah,
and
let's get
talk
into it.
talk about so. The headline out there is Sell America. Sell America. We're talking about stocks, we're talking about bonds, and we're talking about the US dollar all simultaneously selling, right? Now, this is obviously something that is rattling investors, right? And it's reshaping the way that the global investment environment has been for years, right? And think of the whole period in the post 2022 bear market, where we had that bond bear market and the stock market was going down. Since then, we went through a 2-year bull market where US dollar strength and Mag 7s leading the way. The U.S. stock market was 75%. I'm pretty sure that's the number. 75% of the capitalization of the global capitalization of the stock market. If you didn't own the U.S., you weren't making money. Now we've seen that pivot. And that pivot has come from Trump. And while initially there was a lot of sentiment out there that Trump was going to lead this big renaissance, and I still actually understand that in the big picture, that what he's trying to accomplish, when it's done, may very well work. But what is the result on the short term? On the short term, there has been a massive amount of global uncertainty. This started just even a few months ago when the first tariffs were talked about with Canada and Mexico. Obviously, the most recent disruption has happened right now, where last week when on Liberation Day, where the broad global tariffs were announced. But going back even a month or more, when this was just a Canada thing and a Mexico thing, it was the problem was already being seen. What is the problem? Well, imagine you're a business. Imagine you're a business that is involved in some sort of global trade, particularly even, let's say, Canada, the US, or anything like that. When you know tariffs are coming, when you know that Trump is serious, are you going to make the capex spend to expand your business, or are you going to say we need to hit the brake and see how the dust settles and what the tariffs look like before we make any more further investment into the business? And this is what we're seeing, which is literally businesses right across the board are hitting the brake. This is very likely to lead to rises of unemployment at some juncture. Will it be already coming up here in the May month that we'll see an uptick in unemployment rates and the jobs numbers reflected? Well, maybe May, maybe June. At some point, it's going to be reflected in there. And so we basically now have a second variable in that the stock market has had such a sharp correction, because the moment that you see this kind of a correction and everyone sees the market value of their portfolios decline, it immediately disrupts consumer confidence and business confidence and CEO confidence. Everybody's confidence becomes rattled. And that changes sentiment, and that trickles in to the slowdowns that inevitably lead to contraction. And we're witnessing this. Now, our focus today, I wanted to spend all of the time talking about the dollar, but we can't talk about the dollar without understanding what is happening with all of this on an intermarket scale. So we're having the Sell America trade. Now, the first started with the US dollar, the US stock market declining. And the US stock market started declining before even European stock markets started to decline, before the dollar reacted, before bonds reacted. It was first a US stock drop. Now, on Liberation Day, the shock wave spread to almost all global equity. Uh, Here, I'll just give an example, right? So here, I'll just pull up the chart here in the S&P. The S&P 500, basically on Wednesday of last week, Wednesday, sorry, on the 26th, that's a couple weeks ago, was trading at 2,800. And then on the Wednesday of April 2nd, you can observe here, was trading around 2,700. And so at this moment, the market was already experienced a peak to trough 10% decline, and was already rolling over. But before that drop, when you looked at something, for instance, like the Euro stock, right, and we looked at what was happening in Europe, back on April 2nd, we were still trading at 5,300, literally only 200 Euro stock points from the highs. Everything was pretty stable. It was a bull market in the European markets. It was a little bit of a correction for a few days that was getting underway, but nothing that to be alarming. But then it got hammered. Once that Liberation Day trade happened, we saw uh, a drop that made now the European markets literally in 2 weeks drop 17%, 20% from its actual peak. Big drop in, and that was no different than Nikkei. The Nikkei had this enormous decline. Global equity all took it. Now, that in itself is fine. Equity stocks start selling, but it then transformed. It transformed in that once there started becoming new tariff issues and all these different things, it started to spill in the basis trade, which was essentially think of it like spreads, the interest rates between SOFR futures and swaps against Treasury bonds were essentially going inverse, which is not a normal occurrence. And there was trillions of dollars in this market playing these interest rate differentials at a bank level, at a hedge fund level. This is not a trade that retail investors would ever imagine. This is not something any of you that are on this YouTube live stream would ever put on a basis trade. It was something that happened that has now disrupted the plumbing. But what triggered that move? It was Treasury bonds. And so what I want to do is, before we get to the currency, I want to briefly talk about these Treasuries. So let's take a look at this. This is the T-bond futures, which is the long duration bonds. And this pop and drop right over here happened on April 7th. Now think of it this way. On Liberation Day, bonds first actually went up. The normal relationship is that when stock market's under stress, bonds and the dollar usually do well, as there's a safe haven trade rotation, as a weak stock market is reflecting recessionary risks, which allow disinflationary pressures to allow bonds to rise and demand for safe haven of dollars to be there. When this pivoted, at a key moment where essentially, and the speculation could very well be that an international central bank, particularly could have been China, Japan, they started selling treasuries to buy gold. And in doing so, when they sell the treasuries, they're leaving US dollars. It was basically the sell America trade. And this development only happened this week. This has been there was obviously this market decline's been going on for 45 days or so. It's been already a month and a half of pain for investors. But this really ugly part is only happening now. And so it only started now, and it's gotten pretty ugly on the short term. Now, to compound this, when we got the Fed meeting minutes back on Wednesday, it doesn't seem that the FOMC meeting members, the FOMC members, seem overly worried about the bond market yet, at a time when there's clear distribution getting underway. Will the Fed get this wrong? I definitely think so. But that's another live stream we'll do. And when we're talking about bonds, I want to focus again on currencies. We're just setting up the environment to understand why currencies are doing what they're doing. And so we have this trade where if China is, for instance, seeing that the world is massively pivoting and that it's this globalization trade that's been going on for decades, where China has been in this open trade with the US, that with all of these tariffs coming up, that there is a new regime, the new paradigm, a new period within the way global trades are in this multipolar world, and that divide is becoming clear because the tariffs that they're putting on each other, retaliatory ones, is basically ending trade between these countries. Not ending it outright, but it's making it so expensive that goods are not naturally going to move between these two countries. And so the China has all of these US dollar treasuries and US dollar reserves in there from all of the decades of trade imbalances and trade surpluses that it had. And the only logical thing is to continue this process of converting it into gold and selling those US dollars. So now this is really accelerated in this escalation. And this is where we want to talk about what this US dollar has been doing. So let me pull up this chart and talk about what the US dollar did here in the last 3 months. Basically, since the start of the year, the US dollar now has declined from peak to trough 10%. Now, is this the end of the world? Well, some of these huge headlines coming out certainly make it feel like that. Like Deutsche Bank just released a piece, and the headline there is that the market is reassessing the structural attractiveness of the dollar as a global reserve currency and is undergoing the process of rapid de-dollarization. That sounds pretty scary, doesn't it? Right? Like the statement like this. I am not yet in this alarmist camp. As much as I stated it that way, I don't think things have broken down that bad yet. And what I want to do is spend a moment looking at this chart in the bigger picture. And I want us to put it on a monthly chart on the dollar. And we got to talk about some very key things. First of all, let's go back in history. Let's go back to the period of Reagan in the 80s. And I want to highlight that from its 1980 low to its 1985 high, we saw almost a 100% rise in the US dollar, creating one of the most spectacular monthly chart Eiffel Tower formations that us technicians love. Point is, after its peak going into the second half of the 80s, we saw the US dollar wipe out 50% of its value. The question I have for you is, in this 50% decline of the US dollar, did the US dollar lose its world reserve currency status? Was it the end of the world? No. And it was a staggering 50% decline. Now go to the period in the 90s, the Asian currency crisis, and all the different things that was going on from 96, 97, and so on. The dollar rose 50%, 50, through the 90s into the first year of 2000. But after its peak in 2000, the US dollar proceeded to have a 6-year bear market, 2,000 days. It lost 41% of its value over those 6 years. Did the US lose its world reserve currency status? Did the world end during this monstrous US dollar bear market? No. Okay? It did not. So, what I want to highlight is that when you look at these extraordinary moves that have happened, I want to simply put into context the 10% move that we just witnessed right now and recognize we have not seen nothing yet. And now, while there is plenty of room for this to turn into a US dollar bear market, by no means is this the end of the US dollar system already, somehow, like the way many of these headlines are trying to highlight. More importantly, I want to just put into context a couple of things. Number one, let's talk about all of the declines that we have seen in the US dollar since the great financial crisis. Okay, so back here in 2009, we had the US dollar lose 17% of its value in less than a year. In the 2010 period that followed, the US dollar went through a period where it lost 18% of its value in less than a year. In 2016, no, it was January 2017, sorry, that the US dollar lost 15% of its value in a year. We then go and look at the period into the COVID crisis. The US dollar went through a almost 14% decline in about a year. We then go and look at the US dollar in 2022, and then look at it went down 13% in a span of less than a year. What was the current drop? What was the current drop? 10%. Currently, the US dollar drop that we are witnessing is the shortest drop in all of the declines the dollar has had on monthly charts since the great financial crisis. Okay, so I just need that to lead the way for us to have this conversation, because it has been a pretty dramatic 3-month decline. But this 3-month decline has, let me put on actually a weekly chart, but this 3-month decline has only approached all of the lows that were seen over the last 2 years. We saw 100 on the Dixie back in 2023, and we saw it just 2 months before the elections. Think about it. We're only at the dollar level where the US dollar traded 2 months before the Trump election, right? So there's two very big questions. What's going to happen on the short term? And two, the bigger puzzle to solve, are we in a new nasty US dollar bear market that will last a year or 2 years and be far more reminiscent of some of the bigger and deeper dollar shifts that we've had? Now, here's one call I'm going to make. No matter what I say, I want to emphasize one thing. Any move the dollar makes does not in any way imply that the dollar is losing its world reserve currency status. The reason why you cannot make that call right now is because the world lacks an alternative. I know some of you Bitcoiners are there. Well, oh, crypto will play a role, and others will say, oh, the BRICS countries are putting together an alternative. Listen, there are plenty of things that are going to poach some of the US dollar's role as a world reserve currency. But the world lacks an alternative. And also, the world lacks trust in other countries as well, right? Like, so if you're an African country and you're trading with a European country, do you, well, maybe they'll start potentially soliciting euros as a way of exchanging. There will be growth in other currencies being used in global trade, but that might result in the US dollar going from 85% of being global trade to being 65% of global trade. But the US dollar being right now used as the world reserve currency is not going away. It's not going to end in a dramatic bang. It's going to happen gradually as other countries will, over time, find and start trusting alternative settlement means and start diversifying the way that they are settling. So let's just go and make it very clear. Whatever we're talking about is not about the US dollar losing its world reserve currency status. I think that that is going to remain in place on there. But that does not mean the US dollar cannot or will not go into a bear market. The US dollar is very capable of having a dramatic move that is just going to be a move like we've seen in decades past, and there's room for the dollar to make a big move. And so this is where we have to talk about what's going to happen in the short term and then what is actually possible in the bigger picture. Now, by the way, this is a live stream. Any of you that are live with me, type some questions in. The whole point of doing live stream is to interact with any of you. So if there's something that any of you want to think, oh, well, there's Danny. There must be something. Danny, is there
There's a
something that we want to?
there's a few. I think really amazing analysis there you've just made on the dollar. I think what would be really good, and I'm not sure if you're going to cover this in the next part, but it would be really good to help people maybe understand what they can do with their portfolios now and maybe what the outlook could be for the near term future. I think that's something we should cover first, and then there's a few questions come in here as well. So
Okay. Let me address that. That's a great thing to touch on. Okay, so what I want to start off with here is what's going to happen on the short term. Should anyone do something urgently now? And my answer to that is no, because when you go on the daily charts, I want to highlight that we were at Big Picture Trading. Well, we've been on top of all of these major market moves. In fact, we have done over the last 2 months. We've been webinar after webinar talking about this is how you hedge your portfolio. This is how you protect your portfolio. These are the option strategies to protect yourself. And our members made off like bandits with protecting their portfolios, buying the market bottom. Big picture trading members are some of the few members out there that are making money in the last 2 months. So it's been great. We've been on this and doing it. Do I think with that market timing framework that anyone should do anything about their dollar positions? And I'm saying it's too late to act on this move. You don't panic sell now. What do I mean by that? Well, we were basically calling a test of these lows. We were basically saying the dollar is re-entered the trade range and is going to come back and retest the bottom of this trade range. It did so, finishing what we define as a measured move. And so you can observe the target zones below have now been overlapped and achieved inside that. This is where there is no asymmetry in panicking after a 10% move's already happened. You're just making an emotional impulse move if you act now. In fact, I feel pretty comfortable in making a bold call here on this live cast that a short-term low is likely in on the dollar. And I say short-term because it doesn't mean the dollar bear market hasn't just begun in the bigger picture of the next 6 months or next year. We're talking about the tactical period of what's going to happen over the next 1 month. Very likely, this oversold condition is going to have the dollar stabilize in the low 100s. And it's going to settle in there. And therefore, nobody needs to make any rushed panic moves on the currency front today. Or at least there's very little asymmetry in doing so on the very short term. Things, think of it like an elastic band. Like here, I got this like elastic band stretched between your fingers. The thing is already extended way so much that it's going to snap the other way and reflexively bounce at some point. Just the way the stock market had the third largest up day in 35 years on Wednesday. It was just because the elastic was stretched so far that a snapback was going to inevitably happen. Now, that will likely happen in the dollar as well. But does that mean you want to be bullish the dollar? No. It's because it's not technical anymore. There's a genuine macro regime shift that is happening on a global scale that was spurred on by Trump. And what we're seeing is a period where over the last decade, the only thing global investors could own was the US and US dollars and the US markets and US bonds. And now, when all of those US assets are super expensive, there's all of this benefit for global money managers to diversify and sprinkle some of their overweight in the US everywhere else. And this is not going to end in a short window of time. And especially when those other assets start to do well on a relative basis, it becomes a positive feedback loop, or a negative one for the U.S., but a positive one for those markets where, well, if this is where it's making all the money and this is where all the money is flowing and it's been outperforming, well, then money chases performance, and then and that trade begins to compound. This could be the story of the whole year. The way I'm playing this here is that when this market bounces and when things settle in throughout April and into May, yeah, then it's the time to adjust your portfolio. Now, there are two types of listeners we have: Americans and everyone else. Why? Because if you're an American, your investment is in dollars. Your earnings, your pension, your groceries, everything is denominated in U.S. dollars. Your mortgage is paid in U.S. dollars. As the currency is fluctuating, you don't necessarily see changes that are happening to your life based on that dollar movement. That's very different for a foreign investor. As a foreign investor, let's say you're in Europe, or you're in Canada, or you're in Mexico, or anywhere else in the world, doesn't matter where, when your investments in the US are declining, and the US dollar is declining, you are seeing your money being reported back to you in your base currency, and it's far more devastating because you're living your life in a foreign currency, and you're seeing your investments getting double whammied on both a currency and a stock market thing. So, um, as a foreign investor, you need as a foreign investor, you need to diversify yourself and have multiple currency exposures, not just in the US dollar. So if you're a Canadian and your assets are all in US dollars, this is not a good thing. If you're a European and your assets are all in US dollars, right? That is not a good thing. And so foreign investors need on the rallies to bring your balances in equilibrium. One of the things you can consider at minimum doing is owning half of your assets in one currency and have the other currency or a second currency with the other half of your assets. You that way, think of it like a seesaw. If you have half US dollars and half euros, or half US dollars and half Canadian dollars, or half pound sterling and half US dollars, well, as one currency is strengthening and the other one is declining, you're getting much more equilibrium in your overall net worth. As one strengthens, the other weakens. You're getting something down the middle. Point is, our international investors need to be far more diligent to do that. U.S. investors, on the other hand, it really is about hedging. It's about hedging your US dollar exposures and finding ways to know that if the US dollar goes through a major decline and your global standard of living is declining on a relative basis, is there something that you can do to be benefiting from that? And those are things like there will probably be a huge commodity bull market in that environment and all sorts of other things that will be knock on effects from all of that. All right. So, Danny, hit me up, buddy.
Cool. So amazing in-depth analysis there. I hope everybody feels like they've had their head blown off. I imagine that they have. We've got a few things just about the Canadian dollar. So I've got a few here just asking, is the CAD pumping for the same reason as other currencies? Is that something you can answer?
Um, the Canadian dollar is in a unique situation. But the thing is that what we're now seeing is a strike against the US dollar. And so the Canadian dollar, you can see here on this chart, Danny. What we can see here is that the U.S. dollar has been declining against the CAD. Now, the situation in Canada is not that good. The Canadian real estate market is in turmoil. Their trade with the U.S. has been challenged. Very good odds there'll be a recession. But how much of that has been baked in, and how much of people abandoning the US dollar investment and repatriating has caused the Canadian dollar to have a period of strength. My view here is I'm a little more neutral on the US CAD. I think that the moves against the euro and the yen and other ones like this are going to be far more dramatic on the short to intermediate term. No, not short term, the intermediate to longer term. And the Canadian dollar, at least in the intermediate period, through the challenging periods, will, on a relative basis, be giving the least volatility against the US dollar. It's going to be, I think that the US CAD is going to be stuck far more in the mud and grind it out more than it is going to be a collapse in the US dollar relative to the CAD.
So looks like we've had some technical difficulties actually with YouTube. We have been live, don't worry. But it looks like there have been some people that haven't been able to connect earlier on. So what I think might be just a really good idea is not to go over another 30 minutes worth of what you've just said before, because they can watch that later on, but maybe just to summarize the big thing of the big picture of what you said. So basically, I think it's like a very quick summary of what's happening now, what you expect in the short and long term, and what people need to be doing or not doing now.
Absolutely. Let's wrap it up with once again kind of summarizing where we stand on all of this. So what it really comes down to here, Danny, is that this we are witnessing, at least in the last 1 month, a sell everything America trade. U.S. bonds, U.S. stocks, and U.S. Currency all declining at the same time. There's a huge flow out of treasuries into gold, creating an epic gold melt up. And gold is just starting to rip on the upside. But the US dollar on the very short term is likely to bounce. The trader in me is looking for a short term low. So, therefore, the conclusion I'm trying to make here is that this is not the time to panic out of your US dollars after a 10% move has already happened. Right? You have to, at this moment, there's good, just the way when the stock market was at its lows on Monday and we were saying it's extremely oversold. Wednesday, there was a historic rip on the upside of the stock market. The again, using this little elastic thing here, the dollar is so stretched on the downside, it's going to snap a little bit. That doesn't make it a bull market in the dollar. It doesn't make it a buying opportunity unless you're a short-term trader. But it also doesn't make a whole lot of sense for people to panic out of their positions at this juncture. And so, if to get the details again, those that missed this, go and watch the recording on there. But Danny, I need a beer here, buddy. I gotta I gotta go back. It's already 8 p.m. out here in Mallorca,
Yeah,
and
you did a great job. I think we just it looks like YouTube has been having some issues, so it's
oh,
all going to be available to watch later on. But anyway, thank you so much, Pat. Enjoy Mallorca. I'm saying it
I
wrong.
will Mallorca.
Mallorca.
And so yeah, no, thanks everyone for tuning in. I hope you all enjoyed that. We got a market huddle coming out. Listen, I talk like this about all this shit every freaking day at Big Picture Trading. And those of you that haven't tried a Big Picture Trading free trial, you're crazy not to, because it doesn't even need a credit card. You just literally go in there, register, and you get to see what we're doing. We've been nailing these so many happy members. We've been
Yeah.
long tons of gold. We've been short the stock market and covered right at the bottom, and long since it's been a really good run, and let's see if I can keep the streak going.
I mean, I hope so, because you've made me loads of money. So let's keep going.
There you go. All right.
All right.
Anyway, let's get to enjoying the weekend. Good trading, everyone. Thanks.